A very good morning, good afternoon. Welcome to HYCM's Live Market Analysis, FX Look Ahead with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing well. Looking forward to taking us through this session and just really explaining what's going on so folks know how this geopolitical risk is overshadowing the markets, the likely impact it's expected to have, and importantly, what's the trade out of it? So I'm going to be going through that as well as looking at some key events, but the geopolitical risk is really overshadowing markets at the moment. Don't forget that any sort of entries, exits, currency pairs, we're looking at commodities, indices. The whole emphasis of this trade is trading webinar is from an educational perspective. So you can see how I go about making decisions from a professional trading background, and then it's a learning kind of a mechanism. Now, if you just take a look here at the key events, we will be looking, after I've covered the geopolitical event, we'll be looking at some of the key events on the calendar that are coming up. Looking at for the Australian dollar, the pound CPI inflation looks very interesting, and also looking at gold and US oil. So we'll be covering gold and oil as a part of the geopolitical risk, because we can't unpick those from current geopolitical risk at the moment. Don't forget, as I'm going through the webinar, if anything's unclear or you're uncertain of anything, please do ask, and I will try to make things clear to you. So just put in the chat box or the question box any questions you have at any time, and I'll either answer the questions if I can at the end of the webinar or as we go along, depending on how it is. Right. So here we go, and that's an interesting headline. Russian President Putin is asking Foreign Minister Lavrov to present proposals on US response. Now, what happened? Let's just run through it. On Friday night, there was a headline that came out. This is a Financial Sources trading terminal, which I use as part of my analysis for Financial Source. So I'm just going to be referring to that through the session. Now, the US put out a headline that President Biden was saying that Russia and Russian President Putin had made a decision to invade Ukraine. Yeah, thank you, Richard. Well done. I will. Right. Richard, well done. I wasn't showing my screen. Right. So what I was looking at here is when the US said that President Putin had decided to invade Ukraine, that saw an immediate risk-off selling on Friday. Okay, for those of you who just joined the webinar, I'm going through the geopolitical event of Russia and Ukraine, what the trade is out of it, what the trade is potentially if things get worse, and what the trade is if things get better. So just to make that clear. Just recapping where we're at. Friday, President Biden said that President Putin had decided to invade Ukraine. That headline was then kind of contradicted in less than an hour later, where the US said, no, that's not quite the full picture. That's not the White House's view. Then there was another headline that came out about another 45 minutes after that one saying, actually, yes, it was. President Biden had told allies that President Putin has decided to invade Ukraine as soon as potentially Tuesday. So the whole world has been sensitive to a potential Russian invasion of Ukraine. That's where we're at the moment. Now that is overshadowing the inflationary concerns that we had from a very high US CPI print. So we've got these two narratives running at the same time. The geopolitical event is overshadowing the inflation concern. Now, an important point to share with you. One, geopolitical events usually have minimal impact in the stock market. I'll say it again, geopolitical events usually have minimal impact in the stock markets. Can you see here, let's take the 9/11 terrorist attacks, right? Unexpected, but still the total drawdown in the S&P 500 was 11.6%. This attack triggered the collective defense clause in NATO's treaty, and we saw 11.6% total drawdown. But look, the S&P 500 recovered in 31 days. So when you consider what a horrendous event that was, but actually the impact on the stock market was relatively mild. Even look at the Pearl Harbor attack in the 1940s. The total drawdown, again, totally unexpected. So it's not like markets could prepare for the Pearl Harbor attack. It was out of the blue, and even that huge event, which drew the US into the Second World War, and you think of the cost to that, to the world and to the US, and that still saw a relatively mild 19.8% total drawdown in the S&P 500, and it was 307 days before the S&P 500 had recovered. So then you look at some of the, it's a horrible thing to say, but some of the smaller events, although all of these events are terrible events, you're looking at the bombing of Syria. That saw only 1.2% fall in the S&P 500 and 18 days for the S&P 500 to recover. US pulling out of Afghanistan and all the rigmarole and all the turmoil that created, the S&P 500 recovered in just 3 days. So that means the general playbook, as it were, is that if Russian do invade Ukraine, the average fall is minus 1.1% and minus 4.6% drawdown the S&P 500. Average time to recover is about 40 days. So is this as big as a Iraq invasion of Kuwait? Is it as big as a, September 11th? Well, it's debatable. I'll give you that. But Ukraine is not part of NATO. So if Russia do invade Ukraine, it won't trigger a collective defense clause. It won't trigger other nations entering into immediate conflict with Russia, which would be devastating, obviously. So yes, it will have implications, but the stock market reaction, this gives you a sense of what you can roughly expect. Okay, now that's the impact in the stock markets, but the outsized response tends to be in the FX markets. You tend to see large moves, and I was reading a research piece earlier on the financial source terminal, and it was making it clear that sometimes in geopolitical events, risk currency pairs can fall their whole month's range in a couple of days. So just hold that in mind, okay? Because I'm going to be sharing with you the best kind of opportunity that we have in this. Okay, just keeping an eye on these headlines. Russian Foreign Ministry Lavrov tells Putin responses to Russian security proposals from the EU and NATO have not been satisfactory. Putin responses to Russia. Russia will try to get responses from all EU countries. Okay, so we're just, dialogue is ongoing. Now, the risk sentiment that we've seen since late on Friday has been a clear risk-off market. If you don't understand a risk-on, risk-off market, is a very helpful tab from Financial Source. You should know this. Okay, when markets are risk-off, you see downside in equities, upside in safe haven currencies. That's the yen, the Swiss franc, and the dollar. Downside in high beta currencies, that's the New Zealand dollar, the Canadian dollar, the Australian dollar. Downside in commodities, oil, copper. I'll go on to why there's a little bit of a tricky aspect with those at the moment. And upside in government bonds. Now remember, government bonds are attractive at times of risk. So when markets are worried, they buy government bonds. Why? Because the US government, the US 10-year bond, a US Treasury is considered one of the safest investments that you can make. And so it attracts safe haven buyers into bonds. Why? Because governments are less likely to default on their loans than, say, a company or an individual. If you had to invest money anywhere, would you expect the US or the UK to default on their loan? Now, I know the UK has never defaulted on any of its bonds in its history. So you can see that's why investors are attracted to bonds in times of crises. So all of that means, let's go through this because this is a good learning point. See, these are equity futures markets. They've fallen lower, okay? VIX is pushing higher. The VIX is pushing higher on those inflation and growth fears, as well as the geopolitical risk. We've seen the gold has been pushing higher. Now that's been pushing higher because of the fall in 10-year yields. I'll explain that in a minute. Oil pushing lower. Now there's some nuances here, and something else for me to say about natural gas. So first of all, oil. Russia is the third world largest exporter of oil. So what you'd expect is when there was this risk on Friday, right? Oil gained, because why? Russia might not be expecting so much oil, there'll be more demand for oil. But now it's falling. Why? Because if Russia does invade Ukraine, then there's going to be less demand for oil. So there's push and pull factors on oil. So just forget about oil for the moment, because there's a case for upside, there's a case for downside. And the fact that we're at the daily pivot point is fitting. Copper prices have moved lower, but that's but they're finding a little bit of bids going on. Natural gas, now this was surprising because of the fact that Russia supplies around 40, 50, nearly half of all Europe's gas supply comes from Russia. So you can see as this Russia-Ukraine crisis was bubbling, natural gas prices really took off. Now, when we had that news on the weekend that Russia would potentially be invading Ukraine from the US, I was expecting much more upside in natural gas. So this for me is, okay, I want to leave natural gas alone now. I don't know if the markets looked at the fact that Russia hardly ever stops providing natural gas to Europe. Even in the Cold War, Russia didn't stop providing natural gas to Europe. And that makes sense, doesn't it? Because if you think about it, why would you stop selling a key commodity to a key neighbor for trade? It doesn't make sense from a trade perspective. Yeah, maybe make life difficult for Europe for a few months, but what do? You then make your enemies worse, even more enemies with you, and then you open up all these new natural gas supply lines, don't you, with Qatar and North Sea maybe. You just suddenly you incentivize Europe to look for their natural gas elsewhere, and of course they spend the money elsewhere, and then you end up impoverishing your own country. So it doesn't make sense. So natural gas, just hold fire on that now. It's not making sense to me. Bitcoin, again, risk asset. Now let me explain what's going on with gold here. Right now, gold, I'll just explain this here. Right, we're seeing some upside in risk assets. I want to see what that is. Right, I'll quickly check that in a minute because that could be a potential trade. Right, you see at the moment, you see real yields dropping? Because real yields was dropping, that was all the bids came into bonds. Now inflation's high, so when yields drop, that means real yields fall. That's why gold surged higher, because real yields have fallen. Yes, the dollar's a bit stronger, but real yields have fallen more quickly than the dollar's risen. That's upside for gold. That's what we've been seeing here. You see these bids come into 10-year yields. As yields fall, that's bids coming into bonds. You can see here the yield curve. This is the 10 years, the 10 2 years spread. You see that that's dropping. That means the yield curve's flattening. So growth expectations are, being hindered, and the fact that you have those strong bid into bonds around that 2% level, that's what helped lift gold. So if Russia do invade Ukraine, you expect more upside. Now we're seeing some risk on sentiment. You see here, we're seeing some recovery in some stocks, right? Now what's going on? Let's have a look. Right, can see a way move forward with talks. Part of US response to security demands were unsatisfactory, but part of the response was more constructive. Okay, so this is what's changing the sentiment now. Okay, Putin asks if there's a chance to agree on key issues. Lavrov says there's always a chance to agree. Indefinite talks are not possible, but there's always a chance for agreement. Right, so this is like, so if you've never traded with the news swap before, right, then I'm just sending a news swap free trial to you all now. Okay, this is part of the financial source service. I'm sending you a free trial for 2 weeks. Now, this is a trade potentially, right? So remember, we've seen downside in like risk sensitive pairs. Remember I said the high betas? Now these pairs are suddenly finding bids, okay, and that makes sense to find bids now because there's constructive potential for talks. Now, if you look at the RBNZ, for instance, look at the bond yield spread between New Zealand. Look at that bond yield spread. Now, price typically tracks the bond yield spread. Okay, do you see how price tracks the bond yield spread? This is the outlook between New Zealand and Japan. Now, Japan, let me show you something, have said, right, do you see how this price moved up to 0.25% here? Right, now Japan have a target. They want to keep their 10-year bonds, their JGBs, they want to keep it between plus 0.25 and minus 0.25, right? So they want to keep it in this band here and here. So with price moving up to that level, what was Japan going to do? Were they going to defend that level? And the answer is yes. So what they said recently is, let me show you, the Bank of Japan offers to buy 5 to 10-year JGBs at fixed rate with unlimited amounts, right? So on Friday, they said they'll be purchasing 10-year bonds on the 14th of Feb today due to recent yield movements. And now, lo and behold, what do they do on the 14th of Feb? They offer to buy 5 to 10-year JGBs at fixed rate with unlimited amounts. So what that means is that this is what they're doing. They are going to buy the, where is it? They're going to buy the 10-year bond at unlimited amounts. So they're not going to let it go past this level. That means that over the medium term, the Japanese yen should remain weak. Now the RBNZ, they're meeting on February the 23rd, they're meeting in 9 days. We've had an investment bank after investment bank saying that they will be revising higher their interest rate expectation for the RBNZ. Inflation for the RBNZ is at a 31-year high. House prices are like 28, 29% higher than they were pre-COVID. They're higher than the US, Norway, Canada, right? There's a lot of reasons for the RBNZ to hike interest rates. So this means that if we are seeing a return in sentiment, New Zealand dollar yen upside makes sense at market, stops below 75.84. Aussie yen makes sense at market, stops underneath 81.50. And Aussie Swiss francs longs make sense, stops other side of 6546, and New Zealand dollar Swiss franc stops other side of 6091. I favor New Zealand dollar yen upside. Right, now that's a typical reaction, and that is what I was saying is the trade out of this. Now what's the risk? Because every trade has risk. Now the risk is, now this is the problem, you've got to be aware of this. I'll keep the squawk on, I'll keep the new squawk on, so I just put my news on. What they're saying is that, so the way you trade headlines is a little tip for you. You always look at the source. So here, the Russian foreign minister, Lavrov, tells Putin response, da, da, da. So reliable sources, we've got Putin, Russian foreign minister, excellent. Okay, we've got Putin asking questions, we've got Lavrov responding, good. This rhetoric is positive. Now that does not mean that we're risk on. You have to remember, we live in a shady world, unfortunately. So you can never, even if someone says something, you can't fully trust it. Now that can be hard if you're an honest person and you say something, right? You can get confused here because you think, well, you know, if I said I'll meet you at 3, gosh, you know, unless I get struck by lightning, I'll meet you at 3 o'clock, right? Some people are like that, right? They're very honest. Whereas some people say I'll meet you at 3 means I'll meet you at 3 as long as nothing better's happened, as long as I remember, or I said I'll meet you at 3 and I've got no intention of turning up. That's the sort of person I am. You understand? And it's the same with politics. So you have to remember that this could be contradicted in 10 minutes. You know, Putin could be using, and I'm not saying it is, I'm not slowing him, but you know, someone could be using this as a, you know, as a cover for an attack, right? But markets will take the face value as long as the source is good but remember that this can be contradicted. Okay, so at the moment we're seeing some risk on, so we're seeing some recovery in stocks, right? Like China's A50, that looks lovely at market. Remember, the reason this looks so good at market is because China's 50 index, the People's Bank of China, is cutting interest rates. Remember, like over the last kind of bit of time, I've shared this a number of times. Look, the China's 50 index, A shares, look, they've fallen nearly 30%, right? Now, the People's Bank of China is cutting interest rates, so you'd expect these shares to gain over the medium term, right? So if sentiment is more positive, you'd expect to see more upside in China's A50. Stocks can be left just nice and tight underneath that 14,500 region. Volatility pushing lower, okay, on a bit of relief. Oil prices pretty flat, natural gases pretty flat, copper prices just seeing a few bids, which is what you'd expect. Again, copper gains make a lot of sense because February is very strong for copper, so that would make sense for buying copper prices. Bonds, yields moving a bit higher, seeing a bit of selling going on in bonds. And we can see Aussie US dollar, New Zealand US dollar upside. We expect that, a bit of dollar downside. So upside in the dollar, Euro US dollar upside makes sense. We'd also expect to see upside Aussie Swiss franc, New Zealand dollar Swiss. Okay, a bit of bottoming going on here. I hope you see this. I hope this makes sense. The best currency pairs to trade are these four, because that's where likely the best reaction. Remember what I was sharing with you, the geopolitical event. The event in stocks can be more limited than perhaps you'd think, okay? But the moves tend to be outsized in currency pairs. Right. Now that was all by ways of introduction, but I hope that's been helpful. If that is helpful, please let me know. It's very helpful for me to know what is helpful and what isn't, rather than just me thinking I'm just talking, you know, into the air for 20, 30 minutes. Right, okay, I'm now going through into the risk events to look out for. So what we're going to think about, imagine you've got two lenses in your vision, okay? So the first lens is that geopolitical event, that's clouding markets. Now let's say that fades. Putin makes up, Ukraine and Russia come to some kind of agreement, risk returns. Then all of a sudden we go right back into inflation. And the market focus on inflation, and we've got Bullard speaking later on today. Now, Bullard really confused markets recently because he had been saying that there'll be one interest rate hike in March and then maybe another interest rate hike in summer. That was the 1st of Feb. Then last week he just came out after the high inflation and said, right, I think we should have a 50 basis point rate hike. We should have a total move of 100 basis points by July. He just had a total flip out. He turned very hawkish. That sent yields surging, sent the dollar surging, sent dollar yen surging. Let's see what he says today, right? We've also got ECB's President Lagarde speaking. Do check out my blog. And on the blog, I do make clear, you can just look at the Central Bank Watch. I look through what's going on with the ECB. Now, that was the only raise up for rates at the 7th of Feb, right? Now, the ECB made their concern about inflation clear. Since then, the situation has changed. And what they've done since then is there's ECB's Reign, Villeroy, Lagarde, they've all pushed back against a very hawkish expectation for the ECB. Interest rates are expected by probabilities markets to be at 50 basis points higher by the end of this year. So what does Lagarde do today? Does she make a move towards higher interest rates?
Just be aware of a report from Hong Kong. I'm looking for more details. However, Hong Kong locks down residential block in the Hua Fu estate. Okay, that's COVID reaction in Hong Kong. That's important because Hong Kong's a big transport hub in the Near East. Unlikely to move markets at the moment because of the geopolitical focus that we have now. So these two central bank speakers could become very, as long as this geopolitical risk is at forefront, less important. But remember, that is interesting. Monetary policy meeting minutes. Now the RBA will be looked at very closely about
the big issue with the RBA, and look at my blog, don't forget to watch my blog. In fact, let me just give you the link. I do cover these central bank events, you see, under the central bank watch section. And I'll just put that there. Right. Yeah, it's here under this market fundamentals, central bank watch. That's where you should be, right? Now, the RBA have ended their asset purchase program, but they push back against the idea about hiking interest rates. Now, the key thing to look at for Australia is coming in terms of the retail sale, not retail sales, employment data. This is very important for the RBA. If this is strong, then we should still see some bids, further bids come into the Australian dollar. If this is weak, and there's a big miss in the employment data, we could see some pushback and some selling in the Australian dollar. So big focus at the moment is on wages and inflation. So as long as employment numbers are high, labour data is good, that still supports more Australian dollar upside in the near term. So we'd favour near term Aussie yen upside, makes sense. Just watch out for that employment data. The PPI, that's the producer price index, and that is a key input for inflation. So the more it costs producers to make products, what happens when costs increase? Eventually that gets passed on to consumers. So if we see a further rise in PPI, that continues and plays into the fear over rising inflation. If this shows a sharp drop, that could be really nice for upside in gold. So a sharp drop in producer price index means that CPI could be falling, and that should give a nice boost to gold prices, a nice boost to the New Zealand US dollar pair. So look at that. CPI inflation data is very key out of the UK. Now, the Bank of England is expecting inflation to spike at about 7% in April. So high inflation is expected. The trade is if you get low inflation. If this comes in like below 5%, then expect that should be resulting in maybe like upside in the euro pound, okay? Because it takes the pressure off the Bank of England. The Bank of England having to be hiking interest rates to deal with inflation. What they fear in the UK, here in the UK, is a wage price spiral. Now, at the last Bank of England meeting, Bank of England's Governor Bailey expressly said, we've dropped language about a wage price spiral because this is not the issue, what's happening, right? And then the next day, Governor Bailey asked employers not to ask their employees not to ask their employers for wage rises. So in other words, they are fearing a wage price inflation, and understandably. And the issue here is once inflation gets into wages, it doesn't matter how it got there. It doesn't matter if it was a supply chain issue that got it there. It's in the system, because higher wages leads to higher costs. Higher costs lead to even higher wages. Even higher wages leads to even higher costs, which leads to even, you see the spiral, goes up and up and up. So the trade, if there's a miss, big disappointment, then you'd expect pound weakness, be nice to euro pound upside. Again, CPI with Canada, again, a miss is the best opportunity, and you'd expect something like US dollar CAD upside. Inflation is a bit more controlled in Canada. High inflation again is not the trade. It's only if it's a miss that's the best opportunity. Retail sales out of US unlikely to necessarily move markets. What the markets will be focused on here is not a beat as so much as a miss. If there's a big miss, it means that investors will be worried about growth. And if you just look at the flattening of the yield curve, that's what the yield curve flattening is all about. You see, this flattening of the yield curve is all about fears about ongoing growth. Okay, and if retail sales miss, those fears will grow, and you're looking towards potential recession that potentially weigh on stocks. Not really a massive tradable opportunity there, but just watch out for it. Got the FOMC meeting minutes. Again, look for anything that contradicts or amplifies the Fed's last more hawkish twist. So traders will be looking at that to see if there are any clues, anything, any kind of hidden messages that were lost. Employment for Australia, we've already covered. PPI input is going to be important for New Zealand. If that's high, we expect it to be high. That's going to raise expectations for next week in the RBNZ meeting, and they're meeting on the 23rd next week, and they're expected to hike rates, right? And then quietish day on the Friday. But over all of this, you've got that Russian and Ukrainian crisis bubbling away. And let's just see what the latest headline is. Okay, that's it now. So a bit of risk on sentiment coming after that. Folks, I hope that's been helpful. I hope that's you know, helping you understand. If you want, this is like a good, if you've never traded with a new squawk and you came in late, you know, you want to trade with a new squawk, they're really helpful, especially on days like this, and you just have the squawk on, and then if you get the positive headline, you can potentially take a good trade, right? Can see a way to move forward with talks. So, yeah, that's positive. Folks, I hope that's been helpful. Don't forget, we will be back here on Wednesday, and on Wednesday, what I'll be looking forward is how to trade the UK CPI event, and by then, we should have had a little bit of resolution of what's going on with this Russian-Ukraine crisis, and then we'll be back to trading economic data proper. Folks, been an absolute pleasure. I hope that's been making sense to everyone. Looking forward to being back here on Wednesday. Take care and have a very good rest of the day. Thanks, everyone. Nikita, good to have you here again. Richard, Johan, Gary, pleasure as always. Naha, the rest of the guys, girls, thanks for coming. Take care. Have a good afternoon. Thank you now. Goodbye.